All right, hello, ladies and gentlemen. My name is Greg Michalowwski, and this is a special webinar that I give once a month to FX Street. And the title this month is to taper, not to taper. That is the question. I guess probably should have had a question mark after that. Anyway, I'm honored to be here as service to the retail foreign exchange market through the portal of FX Street. They do a wonderful service to the retail foreign exchange market. I noticed, or I've been in discussion with them recently about some of their looking to have little meetup groups, I guess, in various cities around the United States, and volunteer my services to potentially go to one of their meetups as they try to build on the foreign exchange market knowledge base for retail clients. And I'm happy to be part of that process with them, and feel honored and actually humbled by it. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk. All right, let me remind everybody that trading foreign exchange carries a high level of risk and may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure should you decide to trade foreign exchange. Carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital. So be aware and be prepared. Is what I like to say. So please take a moment and look at this disclaimer. Now today, the program, what I want to do is take a look at the fundamentals, take a look at the FOMC interest rate decision, take a look at this taper idea, take a look at what happened in December. And, I don't think there's going to be any surprise that I have to say through this, but sometimes it's good to get your arms around all the fundamentals that go along into a decision. Just, not necessarily now, but for the future as a trader, make yourself look better. This portal and this FX Street is all about education. It's about trying to make you a better trader, not just for today, but for tomorrow. And then I'm going to go and take a look at some of the charts. I'm going to take a look at how I approach trading the FOMC decision that's going to take place at 2 p.m. And you can give you some pointers from my experience about what works best, or things that you hope work best. Nothing's ever guaranteed in foreign exchange trading. Nothing's ever guaranteed in these types of markets that we're in, this environment that we're in, which is, I think, admittedly a little bit less liquid than it was in years past. We have a lot going on in the foreign exchange market, increased regulation from a retail side, increased regulation from an institutional side with Dodd-Frank. There's also a lot of investigations being done in the foreign exchange market, which is taking liquidity out of the market. It's making technical analysis even more important in your trading decisions. So I hope to give you a roadmap, a framework for how to look at the market from a technical perspective during those most volatile times like the FOMC interest rate decision. Now, if you recall, a month ago, in December, it was thought the FOMC would not taper. In fact, if you take a look at the Bloomberg estimates there, you can see that the December 18th at 2 p.m. Eastern Time, the Fed's Q3 pace would remain at 85 billion per month, and that was made up of 45 billion worth of treasury purchases per month and 40 billion of mortgage-backed security purchases per month. After the fact, we saw that there was a $10 billion change, 5 billion in the pace of treasury purchases and 5 billion in the pace of mortgage-backed securities. So the market was surprised, or at least to the estimates, the surveyed economists who are experts in the field did not expect that the Fed would taper in December. They went ahead and they tapered in December. And if we take a look at the statement as well, we get a vision of what the Fed was thinking at the time. Labor market conditions have showed further improvement. Spending businesses fixed investment advanced. Fiscal policy is straining economic growth, although the extent of restraint may be diminishing. So we have this vision of labor. We have this vision of businesses and households, and then we have the third wheel, the fiscal policy, which has been this restraining growth, although they expect that to be diminishing. So that's saying something in that sentence that the Fed is looking forward to a little bit more, less restraining growth in 2014 going forward from the fiscal side. And as long as the household spending and fiscal investment and labor can continue along its path, and things are good. The committee expects that the appropriate policy accommodation economic growth will pick up and the employment rate will gradually decline, which is what we have been seeing, the risks to the outlook of the economy. And the labor markets having been more nearly balanced. So there's a consistency in the labor market and the economy. Inflation persistently, though, remains below 2% objective, could pose risks to economic performance. Those are the first two paragraphs. And it's important, again, as you as a retail trader, to understand where the Fed is coming from and where they're going and what they're thinking at the time of their interest rate decision, and also as a way to kind of gauge this month. What are they thinking this month? Taking into account the extent of federal fiscal retrenchment since the inception of its current asset purchase program, considering the government's retrenchment, the committee sees the improvement in economic activity and labor market conditions over that period as consistent with growing underlying strength in the broader economy. Despite the fact that the government has been retrenching and not participating in this growth over the last few years, despite that, the labor market is continuing to grow. Cumulative progress toward maximum employment and the improvement in the outlook for the labor market conditions. The committee decided to modestly reduce the pace of its asset purchases. There it is. There it is in the sentence there. The Fed has this forward look, and they also take a look at the past, and they say, despite the fact of all that stuff that's going on in Washington, it's not going on, and that we are actually seeing labor market conditions increase. So they go through what they're going to do as far as cutting the taper. And we change the tone here now. Maybe this is now what are we going to do going forward? And this is most important for this month. The committee, and going forward for the taper. The committee will closely monitor incoming information on economic and fiscal financial developments in coming months, and will continue its purchase of Treasury agency mortgage-backed securities and employ its other policy tools that are appropriate until the outlook for the Labor Department is improved substantially in context of price stability. If the incoming information broadly supports the committee's expectations of ongoing improvement in labor market conditions, inflation moving back toward its longer-run objectives, the committee will likely reduce the pace of asset purchases and further measured steps in future meetings. A little bit ambiguous, admittedly. What does it determine? Improvement in labor market conditions, or this not improvement in labor market conditions. How long or whatever. But I think what is key in this paragraph is measured steps at future meetings. Measured steps. So they have they set the step at 10 billion, and they want to take these measured steps along the way, and they give that visual of the stepping forward. When you step, you tend to step forward and or step up, or that's sort of the implied where we're going, and that's the direction of what we're doing. But they do warn that they're not on a preset course, and that policy can change in a way to kind of keep things balanced and try to prevent a situation whereby maybe the bond markets get out of hand. Anyway, going to the last paragraph. Ben Bernanke, Dudley, Bullard, Evans, and Esther George and Rosengren I had crossed out here. Why are they crossed out? The Fed makeup is changing this month. Every year, in the beginning of the year, the Fed rotates four regional bank presidents in and out. And Bullard, Evans, Esther George, and Rosengren are out this month. They were in last month. Three of them voted for the monetary policy action, along with Ben Bernanke, who is his last meeting this month, as we all know. And the rest, Janet Yellen, of course, in there. But Bullard, Evans, George, and Rosengren are out of the voting this month. They're being replaced by Fisher. Oh, darn it! I had it written down, but I don't have it. But I guess the point of this from this thing, and I'll get to those names in just a second. But Rosengren was a dissenter on the board. The rest of them voted with the chairman. Voted to have increased or start the tapering process. Rosengren was the only one, and he's not on the board anymore. So, if anything, the board has probably turned a little bit more hawkish or on the taper path without Rosengren voting there. Esther George was a hawk all along, so she's happy, but she's gone. James Bullard was moderate, and so is Charlie Evans. Plosser, the Chicago Fed's Plosser is taking over. He's more of a hawk. He's one of the members taking over. The other one is Richard Fisher from the Dallas Fed. He's also a hawk, and so he's most definitely on board as far as tapering goes. But anyway, I just want to point that whole thing out. The Fed also last month gave central tendency projections, and it's hardly likely, although they won't promote. They won't give their central tendencies at this meeting. That will be saved for next meeting, which will take place in March. But the central tendencies, green represented that they were actually better. In this case, the GDP estimate was better than the prior estimate in September. Yellow is pretty much unchanged, and red shows a little bit of a tendency to the downside. And you can see that GDP estimates, although we have a little red up here, it's only by a little tenth of a percent. That's the central tendencies differ from September. But growth here for GDP growth, according to the Fed, is supposed to be 2.8 to 3.2 in 2014, 3% to 3.4 in 2015. So an acceleration of the growth, and then a slower growth in 2016. Probably as the Fed starts to think about not only getting rid of taper, but also tightening in 2015. That's their projections. The unemployment rate is supposed to decline steadily to 5.8 to 6.1 in 2015. Move its way down to 5.3 to 5.8. So the Fed's projections, remember they talked about that in their statement, the projections are for an acceleration of the economy, both in GDP, with GDP moving higher or staying steady to higher, and the unemployment rate moving lower yet. PC inflation and core PC inflation, those are the wild cards here to the Fed. And I think to a lot of central banks around the world is how inflation will react, how inflation will it move toward the central tendency, which is more toward the 2%. And as you can see, going into 2015 and 2016, despite the fact that we have a stronger growth and stronger employment, the Fed only sees the inflation rate moving back up to, at the maximum, the higher or the target rate of 2%. But at least it's moving toward that level. If the ECB was looking at this right now, they see inflation staying well below the 2% through the next year. In fact, there's just mathematical reasons why the ECB inflation rate is going to be, probably on this side of 1% going forward. Namely because a big increase from a year ago is going to drop out in February. But anyway, that's for another day. Anyway, so what was the picture in December when the Fed did decide to taper? And at that time, we were seeing GDP at 3.6 at an annualized pace. Admittedly, inventories were a big increase for that GDP at 1.68. Since that time, that GDP for the third quarter has been revised to 4.1%, by the way. And we are expecting a new GDP to be released later on this week. Matter of fact, after the FOMC decision, the fourth quarter kind of first cut. Now, we're still getting data for the GDP for the fourth quarter. In fact, today we had a disappointing durable goods orders number, which likely would subtract a little bit from that GDP in the fourth quarter estimate. But the fourth quarter estimate for GDP is supposed to be coming pretty decent later on this week, with an annualized percentage of 3.2% for fourth quarter. That is coming off the 4.1% annualized pace that we saw in the third quarter. But anyway, at the December meeting, the Fed was looking at a 3.6% annualized GDP, enough for them to think about tightening. And also in December, they were looking at an employment situation which showed 203,000. It should be K, not KK. 203,000 job increase versus 185 expectations, and there were revisions to the prior month. So you see the trend in the employment growth was, somewhere around the 200,000, a little bit above here, a little bit below the 200,000, and at 200,000 for the prior 2 months. So growth was around 200,000. 12-month average of non-farm payrolls was near 191, near the high for the year. This is the 12-month average for the non-farm payroll, so pretty good, decent number there. And the 3-month average for non-farm payroll is again around 200,000, which is a pretty nice pace of job growth. Now, they also saw an employment rate that had moved to 7%, but the unemployment rate was falling as well, but still rather high at 13.2%. So a little bit of a disappointment, but the trend for both of these rates are certainly to the downside. So the Fed saw encouragement in there. This is one of those charts which I think is most important to the Fed, and I'd like to spend a little bit of time, I guess, explaining this. And what it shows is the recessions, last 4 recessions, job recessions that the U.S. experienced. The first one is this green one that was in 1990 to 1993. And you can see that the amount of jobs that were lost. And this starts at when the jobs started to get lost. And so it accumulates the amount of jobs that were lost until we start to get jobs being added, and it adds those numbers up. And as you can see, it took maybe about 32 months for that cycle to finish, from when the jobs started to get lost and accumulate to the downside to a drop to when jobs started to be gained and when jobs finally got back to the break-even point right here. So it took about 32 months or so for that cycle to be complete. Actually, the first one came in the blue one right here. This is 1980 to 1983. Kind of got myself ahead of the game. But the trough in this one was much deeper than the 1990 job recession, where we lost nearly 3 million jobs. In fact, it was the second worst job loss period. But it didn't take long for that job recovery to increase. Jobs lost became a point where they actually needed the jobs, and about 18 months or 16 or 17 months into the process, jobs started to come back, and another 11 months later, so that we had reached back to the break-even point. So it was a pretty quick rebound in that job recession. The 2001 job recession, more prolonged. This was the internet bubble bursting here. Lots of jobs being lost. Nasdaq stocks getting hit hard. And this took about 48 or so months for the job recovery to occur. This red is what we've just experienced, folks, and this is nothing to sneeze at. Look at the amount of jobs that were lost. 8.7 million jobs were lost in the last job depression, I call it. But look at the recovery here. Apart from at the beginning where we had this looked like an acceleration of the pace, very similar to what we saw here, a quick acceleration pace to the upside, maybe right here in relative terms. And then we saw this correction, different from this move, which was pretty steep to the upside, albeit with a dip in the middle and another steep move to the upside. The job recovery this time has been slow and steady. Slow and steady wins a race. It's been the tortoise and the tortoise really and the hare here. It's been a slow climb, but the climb has been consistent. The climb has been steady. The climb has been has given the Fed the confidence to taper. And this more than anything, I think, probably contributed to the Fed's desire to taper, is that we're getting close to that zero line right here, where all the jobs are recovered. These amount of people are now working. This accumulation of these people are now working. Not only that, the rise, yes, there's little accelerations here, there's little decelerations here, and there's a little acceleration here and deceleration, but it's consistent. I think that's most important. PCE is a problem, but it's not making the Fed. It didn't influence, or it's not making the Fed decision to taper any more difficult. They expect PCE to increase. This is probably one concern of the Fed, is the amount of purchases on the Fed's balance sheet. Went from the bonds purchase here from about this is $4 trillion up here. So this is half a trillion. So if this is $4 trillion, this would be $1 trillion. This would be half a trillion. Quite a big pace of bond purchases here, and bloating the balance sheet of the Fed to taper by 10 billion. Not going to slow this down by too much. You're going to see a little bit of a move, a flattening. It's not going to be at the straight line trajectory. As long as you buy 85 million per month, it's going to pretty much go on a straight line right there. But it's going to be dipping down a little bit. And I think the Fed's a little bit concerned about that. Retail sales were increasing in December at the time. That was a nice move in auto sales. Surprise to the upside as well. So what does the landscape look like now? And first of all, the expectations are a little bit different than what we saw last month. And the Fed is expected to change the taper by $10 billion. The Fed or the market is taking the perception that what the Fed said is what they meant, that they look to continue on a path of measured steps along the way, and those measured steps, if it were to end in 1 month, would be a surprise. Nevertheless, there are some people who, especially this week, who started raising and ringing or shaking the worry beads about reasons for non-taper. And there are some out there, I see on CNBC and such, who are suggesting that, the Fed could, in fact, not taper. And what are those reasons for the potential non-taper, and why do I not think that's going to be the case? I do think the Fed is going to taper by 10 billion right away. Employment in January was weak. And if you take a look at the employment report, remember we're seeing the numbers up toward the 200,000. Well, last month we came in at 74,000, but if you recall from the prior chart, this number was more toward 200,000. It moved up to about 243. It was revised up about 38,000 to the upside. So this came in a little bit stronger than expectations, but a big dip down to the downside, similar to what we saw here, similar to what we saw here. Or these values are related. The difference between here and here, however, is this was saw the prior 2 months also showed dips. These aren't showing dips. This seems like an anomaly, doesn't it? It seems out of the of what has been happening. And in this case, this was an anomaly to these months right here. And the next month we saw the rebound to the upside. So what happened in last month was explained away by the harsh weather. Okay, there was harsh weather in the survey period. In fact, there was some harsh weather in January as well. So we cannot we may not be surprised if we see another weakish type data in January, and then whether or not the Fed explains it away to harsh weather. These frigid temperatures that kept people inside. It's still keeping people inside, actually, in places like Chicago and stuff, where the temperatures are minus 20 degrees or so. Schools are being closed and stuff like that. Not a lot of economic activity can take place during that time. People who are in fields and get called up and say, "Are you working right now?" And they say, "Oh, no, I'm at home." they are counted as unemployed in survey results. And so that can have a huge effect on the survey results. And 1 month does not make a trend, and I think that's the case. The average non-farm paid tradable change for the calendar year remains steady at 183,000. I think the Fed's going to take solace in that idea that that is very important to them. Is that not only do we see steady, that we see job growth over the last 4 years, 39 months, as a matter of fact, in a row of job growth, positive numbers, but the averages have been very steady as well. Now, last month, admittedly, was, if you take a look at the details of the employment report, construction lost 16,000. The prior month, we gained 19,000. That's a difference of, that's 35,000 jobs from being positive to negative there, a swing of that amount. Just when things like new home sales and construction spending starting to move higher, we have the harsh weather taking construction workers out of the situation. I expect that at some point or another, we're going to see that number bounce back. We're going to see that positive number come back. Trade, transportation, and utilities. If it wasn't for that last month, we would be in deep trouble. It was congruent with the prior month when we added 241,000. The rest of the report here in the other sectors, fairly unimpressive. Professional business and services down to 19 here from 41. This has been a steady job addition or where jobs have been created. And look at healthcare, health services, unchanged on the month. That has traditionally been a large job supplier or a sector that's been adding jobs to the service. Something's not right in some of these data points, like professional businesses and education and health services in last month's data. Look for a better increase. So I think the Fed will look at this data and say something's just not right. There's an anomaly going on there. We saw the unemployment rate continue to move down to 6.7. The Fed has to be pleased about that. The labor force, though, participation rate is down as well as is the civilian labor force here. This seems to be a worry from a lot of people out there. What about the labor force? Some of the Fed officials subsequently, Richard Fisher, Glosser, has suggested that the Fed and most economists expect the civilian labor force to decline over time and for this to be a dynamic within the economy. It's not surprising to them as the population gets older. The demographics of the population are going to lead to a lower civilian labor force. It's still unsure whether or not that is going, what the implications are going to be for that going forward in the overall economy. Will people who are leaving the labor force be as willing to spend money than versus the time that they were in the labor force working in the economy? And some may argue, well, they sold their house because of the better housing market, so they're more flush with cash, and so their retirement is a little bit more set, and so they can, they don't. We know that retirees don't spend 100% of what their pre-earnings spending was, but they just spend a decent amount of it. Plus, the fact that they're leaving the labor force allows other people to perhaps get those jobs that weren't available to them in the with a bigger supply of labor out there. So it allows them to train and to get on the job and allows the unemployment rate to go lower. So you can't deny the fact that the unemployment rate is coming down 6.7%. That's good news. And I think the Fed's going to take that into consideration. And again, the 39 straight months of jobs, of picking away at the job losses, moving closer and closer to that point where we're at break even with the amount of jobs lost or amount of jobs gained. 8.7 million jobs declined, 7.5 or 6 or whatever jobs added now. That's a lot of people who are working, allowing jobs beget jobs beget spending begets more jobs, and so on and so forth, allows the engine in the economy to continue. So I don't think there's a problem as far as the 74,000 decline in the stock market. If you look at the overall big picture of the thing, and the fact that the harsh weather contributed Stock market weakness is another concern. Today, of course, we're seeing the stock market move back to the upside. But the S&P, let's be honest, folks, it went up 26.4% in 2013. Today, when I looked at it, it was down 3.13% in 2014. Now, we don't want it to go 3.3% every month, but it's these types of numbers are not alarming after a 26% increase. So although the stock market is down, although the stock market may go down further as a result of a taper tomorrow, I don't think it's a problem. Emerging markets, I'm not sure I've ever seen in the minutes of a Fed where the market where the Fed has said the value of the Argentinian peso is a concern. For us, this is the spot rate of the Argentinian peso, the dollar versus Argentinian peso. The dollar's moving up, the Argentinian peso moving to the downside. And admittedly, that movement is a pretty decent percentage move to the upside here. But if you were to, if there's all this movement out of the Argentinian country there, the stock market from July of this year till January, just a few days ago, as a matter of fact, had moved 100% to the upside, folks. 100% to the upside. It's declined 11% off of that high in the last few days of trading in Argentina. But you can take a devaluation of a currency of 20 or 30% if you made 100% on your money in the stock market. So again, there's no reason or justification for the Fed to be concerned about the emerging markets and the impact of what a tapering might do to them. That's part and parcel with those economic situations. This is dollar Turkey. It too has been the dollar versus the Turkish lira has moved sharply to the upside, so the Turkish lira has declined as well. And unlike the Argentinian stock market, the bourse in Istanbul has been more to the downside, losing 31%, as a matter of fact, since mid-year of last year. So losses are mounting for those people in the Turkish markets, and capital is fleeing that country. But they're also to blame a lot for the capital moving out of the country, not only from the stock market standpoint, but also from a currency standpoint. So, it's manage your own house. The Fed's not going to be concerned about that. Bond yields to rise. This was a concern last month when, and prior to last month. What will the bond market do when the Fed starts to taper? The Fed starts to take out bond purchases, and the bond yields since December 18th did move up to about 304, 303, and they're down at 275 currently at the moment. So bond yields have actually come down from about 289 to about 275 since the last taper. This gives the Fed actually a reason to think that they should taper. Take advantage of the fact that bond yields are down, and if yields start to back up a little bit more, that would just move up to somewhere around 3%. The market seems to think that employment or inflation is still going to remain a little bit steady, not get out of hand, and that the market can absorb it. Anyway, employment steady, stock market declines are corrective. Emerging markets, not a problem. Bond markets lower. Other economic data, some weaker data recently, but could be weather related. All right, now let's talk about trading the FOMC and get into a little bit more specifics about levels that I think are going to be key in tomorrow's trading. And we'll also take a look at last month and what happened during that period, just to outline what these points that I'm going to make right here. And first of all, understand that risk is elevated. There's always market risk, and that's going to be high. There's always event risk, and that's going to be high as well. And there's liquidity risk as well, and that is going to be high as well. So tomorrow at 2 p.m. when the FOMC announces their taper, whether or not it's 100% certain that they're going to taper by 10 billion or 98% or 97 or whatever it is, the amount of taper that they're expecting, there's still lots of risk in the market, and the market is going to react. So I try to avoid risk, and so keep that in mind, that risk is at a higher level, and I'll talk about how you can avoid that risk in your trading. 50% chance to lose big, 50% chance to win big off of the number. Although we may think we know which way the market may go, we aren't necessarily guaranteed that the market will in fact go that way, and illiquid conditions in the market in particular could contribute to that. My goal is to trade tomorrow, not trade tomorrow. I just speak in just a overall every day. My goal is always to be able to trade tomorrow, not blow up today. So tomorrow, when we look at this, it would be the same mantra will be in effect as well. That I want to trade the next day and not blow up today. So tomorrow when we go look at the FOMC decision, understand that your goal is to be around tomorrow to trade. So make sure that you understand that risks are high and that you have to understand where what you should try to do during that trading of that as a result of that risk being high. And if my goal is to trade tomorrow, always be sure that I trade tomorrow, not blow up today. My goal is to define and limit risk. Make sure that I understand where my risk is at all times. If I do not understand my risk, I have the chance to blow up today and not be able to trade tomorrow. So always make sure that you define and limit your risk, and I'll show you how. And the other thing they have is or one of the things that I suggest all traders should do is trade after the event. When risk is back to the market risk. When risk is back to the market risk, trade back, go back into that point, and go from there. All right. Are there any problems with the? Oh, geez. All right. There we go. All right. I get it. I was just reading some of the comments here. Anyway, take a look at the, and to demonstrate the, risks, involved in the market, that you could face tomorrow. One way of looking at it is look at what happened last month. And although the Fed wasn't expected to taper, and the Fed tapered, what was the market reaction in the euro versus U.S. dollar in action last month? The market went quickly to the I can't even tell. It initially went to the downside, and then it shot up to the upside here. So when the euro goes higher, the dollar goes lower. And that is totally incongruent with what you would expect if the Fed was going to taper situation. So we not only went flying to the upside, we went flying to the downside. We went all the way up, back up, and through the high price for the day, and through the high price here, making a new high. And then the trend started to establish itself in a more logical way. This activity from last month is a reason why I always try to tell traders that trade after the event when the risk is back to just market risk. Now, this was, as a matter of fact, after the event, the market went down and moved to the upside. And in reality, folks, if the market would have done this and I started to follow along with the rules that I'm going to look at here as far as trading event goes, I stopped myself out. The market went back through resistance levels, went back through 50% retracement levels, and started to move back to the upside, and would have gotten stopped out. But the trend, which most people expected, continued to the downside here, and things got a little bit more normal here. You can see it in the way that the bars got more normal size. These bars were still in illiquid liquid markets right here. So if you wait for an hour or 2 hours after the event, and prepare yourself to do that, oftentimes you'll be able to, or maybe even 20 minutes or so. Try to look for areas where the bars become a little bit more normal. Okay, when the bars make a little bit more sense, and utilize your technical levels along the way as well. Some of the other things that I look to do is pick liquid pairs, euro dollar, dollar yen, define multiple technical targets above and below the technical above and below define multiple technical targets above and multiple technical targets below, where you can define your risk and limit your risk. Assume that a move higher or lower will continue in its original direction. That didn't happen last month. That's why I got stopped out on the initial trade, but then was able to get back in on the trade when the market started to show its true colors in the technical sense. After the original move, look for the enter on retracement. Define risk and limit risk, and only risk 2 to 3% of your capital. That's why I got stopped out because I don't even risk 2 to 3%. But if you on a position, it's just too risky for me to risk that amount through that number. But if you get stopped out, it oftentimes is the right thing to do, even if the market ends up going back the other way, the way that you expected. But oftentimes it'll save you from those spikes in the opposite direction. Be aggressive on a break of a target level. We'll be looking for that. Define risk and limit risk, 2% or 3%. And the other option that you have is don't trade. Wait for the risk to disappear. So what I thought now I would do between now and the end of the show is take a look at some of these rules here and apply it to the charts, and to define in particular target levels, key technical levels that I'm going to be looking at in say the euro and say the dollar versus yen, the major currency pairs. I do think that you should trade those currency pairs first. So I'm going to switch over to my charts here, and please let me know if you see the chart. All right. First I want to show the dollar versus yen last month, what happened. Typically, you'd expect no taper that the dollar yen would move to the upside. Well, the dollar yen did move to the upside originally, and then came down where we find support against the 100-bar moving average. Anyway, so then it started its trend move to the upside. So it was a little more dollar friendly, I guess, or market friendly, that currency pair. But the way to look at the market in tomorrow, I'll take a look at the euro versus U.S. dollar first to start off with, and I want to get first a broad view of what the euro's been doing lately. And lately, it's been having a difficult time here. This is a weekly chart, but we hit a key resistance level up here at the end of December, at the high of the year, as a matter of fact. The market came to a trend line point here and a trend line point right here. And the market found resistance against there. And we've been backfilling to the downside, but that move to the downside hasn't been, this is that high right there. We've seen some choppy action along the way. And in that process, we were able to find some support against a pretty good support trend line here on the daily chart. So just as a broad view, we know that this high right here corresponds with this high right here, and we know on the daily chart that these lows right here correspond with a nice little trend line on the low. So this high right here and this low right here, we're in between those two regions. Do you see my chart? Everyone, is there a problem? Other than that. No, okay. All right. So just off the bat, the euro versus U.S. dollar, where do we sit in between this support and this resistance up here? Right in the middle. Right in the middle. In fact, the middle of this range right here is at around the 136.90 level, and the high today pretty much got fairly close to that level. The high today came in about 136.87 and a half. So we're setting ourselves up. So I'm just going to ignore the comments going forward, unless it pertains to the presentation. If it doesn't work for you, then reboot your computer or whatever is my suggestion. All right. So first things first is I always try to look for a line in the sand, a level that is going to be bullish above and bearish below. Now, if the Fed should taper, what should the dollar do? The dollar should go higher, shouldn't it? The dollar, and when the dollar goes higher, the euro goes down, the dollar should go higher. So all things being equal, if the Fed should taper, I have a little bit more of a bias to the downside. Doesn't necessarily mean it's going to work out that way, but that would be a bias. Now, the 50% retracement level here at 136.90, 98.7 level, let's call it 137 level, also happens to correspond with near this high right here. In fact, the high came right at 98.7 on this daily chart right here, on this point right here. Came in at 97 on this bar right here. We went through that level. Market should have gone higher at that point. It did. It went up 61.8 and then came back down. And then today, as mentioned, we got up to a high of about 87. This level comes in at 98.7, so we got within about 10, 11 pips of that level right there. But over the last, in the month of January, we've had one high there. We had another high there. We had a break to the upside that failed and couldn't stay above that level. Another try to the upside and moved down, and then moved down to the low. That was just this week of trading, and then a high up there. So if the price is going to go lower, where would you want to see the price stay below? The 136.98 level or 137 level would be a nice little line in the sand, folks, that you can define your risk and limit your risk against before, during, and after the event. I would look more toward after. As long as the price remains below the 137 level, I'm okay being short the euro versus US dollar. If it moves above the 137 level, then something else is wrong. That may be the situation that we saw, like in just the equivalent of the dollar versus yen, where it went the wrong way, and it stops itself out. But you also have the ability to get back in if the price moves back below the 137 level. So off the bat right now, just write down the 137 level on your notepad as a level that's going to be of significance in the euro versus US dollar, or that I think is of significance. A line in the sand where traders can sit there and say bullish above, bearish below. And once you have that line in the sand, or you find an equivalent line in the sand, a technical level that you can lean against, that you think the market sees, that understands, that can hang their hat on, that becomes your bullish above and bearish below scenario. So let's say the market starts to move lower and doesn't even approach that 137 level. Now you start to look toward what is called targets of where you should be going. Where is the next level that needs to be broken in order to keep the bears in charge, to keep the bearishness going? And these levels end up taking over for this 137 line in the sand that we start off initially. So when I look at the chart, I look at 137 and say, don't stay below it, and I'm going to be bearish through the number. So the number, or the taper comes out, they taper. Are we staying below the 137 level? Yes. Okay. Where is our next target level for the euro versus US dollar? And if I were just looking at the daily chart, what levels come into play here? And I look at this blue line right here, and this represents a 100-day moving average, a simple moving average. 135.83 is where that level comes in today on my chart. And as long as if the price gets through that 100-day moving average, what would be the next target? And for this, I look at this trend line right here. This trend line connected a high. We broke through that high. We came down to it. We came down to it. We moved above it. Admittedly, at this beginning of the month, we had ECB meeting and interest rate or non-farm payroll. Market moved lower, and then we reestablished the line right here. Reestablished it here. Went a little bit below it here as well. It's an okay line, but get below that level. And more importantly, this line right here. This is a pure little technical trend line right there, where we have a number of different points along it. And you can see that the difference between here and here is not that much. So where would our targets be on the daily chart? Get to the 100-day moving average, get to this trend line and break this trend line. If we break through this trend line, we're going lower here in the euro versus US dollar. Where we stand right now to this line right here is about 113 pips, 116 pips from where we are right now down to that line. Is that line in play tomorrow? And the answer is yes. If we break through that line tomorrow, what would you expect? I would expect the market to continue further down. I would expect to take out the lows right here. I expect to go down to the bottom side of this trend line right here, which would be down at the 134.55 level. If we went that far from here down to that level right there, that would be 200 pips to the downside. Is that doable? And the answer is yes. So those become all targets along the way on the downside. So again, stay below the 137 level. Look for a break below the 100-day moving average. If we go below the 100-day moving average, what are you going to do with your stop loss? Probably move it down from that 137 level and manage your risk through each of the target levels along the way. As long as it continues to go in that directional bias, you have the bears staying in control. All this can happen after the fact. Remember, the other thing to remember is we're in a fairly narrow trading range. Look for something bigger. Look for a break outside of this trading range. And moving 100, 200 pips or down to even this point right here at 133.60 is not out of the question. That's a 200-day moving average. So off the daily chart, you can have a roadmap here, a roadmap that takes you down through the 100-day moving average, to the technical trend lines, to the low, to the bottom side trend line, to the 100-day moving average or 200-day moving average on the downside. And then you can go even further if you put a Fibonacci from this low to this high. The 50% of this move to the upside here comes down here at 133.18. It's important to know where you're going in the trade, and that's the importance of it as well. Now, in between, below the 137 level, you also have this 38.2% retracement level, which is about where we're sitting at right now. And you also see this green line right here. This green line represents the 200-hour moving average. And I'm going to throw that into play as well here in the downside by looking at the hourly chart. And go to your hourly chart, put a 200-hour moving average on it as well, and utilize that line as well as an interim level, 136.07. So I have that as a horizontal line cutting across here, 136.07 is where that line comes in. So stay below 137. We go through 136.07. 100-day moving average of 135.83, trend line support of 135.36, and move our way to the downside. As each level is taken out, move your stop loss down. This comes after the fact, trade it after the fact, know where you're going. If you have a roadmap, you have better chance of following that roadmap along the ways toward its targets. Once the market gets down to this line right here, or to this line right here, expect for the market to stall at this level. And then watch for the correction up to the 100-day moving average. This may be the opportunity that you get to get in the trade on the break through that level. So in other words, the market breaks to the 100-day, comes to the trend line, finds support for obvious reasons, corrects back up to the 100-day moving average. Look for the sellers to enter here and break through that level. Look for the momentum on the moves to the downside. That's how I look to play the downside. On the top side for the euro, I use the same 50% if we move above the 137 level. If the Fed, for whatever reason, no taper whatsoever, the dollar gets hit, the market moves up through, guess what the next level is going to be? 61.8% retracement at the 131.44 level. The level corresponds with our high. Then I put a horizontal line across the tops right here. We did break through that top right there, moving to the upside here. In the process, the market failed up there and then came back down, fell below that level and moved lower. So this trend line comes to play at 137.92. So we're going to go through 137, 137.44, 137.92. And we look through this high, look through that high, and if we move through those levels, the market is through our high price here. We are up testing this line here on a weekly chart again. And that's going to be a key level up there. Interim level in between 138.32. That 138.32 level represents a 61.8% retracement. And look at the amount of resistance that we had at that 32 level up here. I'm going to go to the daily chart right here. Here's the 32 level. That's where the market peaked here. The market came up to that level here and sold off, came up to that level and sold off there. So this 138.32 level is a key level for not only the high prices, but it also represents the 61.8% retracement. All right, for the dollar versus yen, and I ended up here taking a look at the dollar versus yen. The one thing that is a key in the dollar versus yen is a 61.8% retracement of the move down on the weekly chart. Put up your weekly chart, put a Fibonacci retracement from the high to the low. The 61.8 has been a ceiling here for this currency pair. If you don't know this level is important going forward. And not far away from that is also another technical trend line going all the way back to that point right there. So make sure that you understand where these levels come: 106.27, 105.57. Now where are we now in the dollar versus yen? We're actually we showed some bearishness over the last few days with the declining stock market, and a lot's going to be dependent on the stock market as well in trading going forward here, as ladies and gentlemen. But we are seeing a rebound in the stock market. We're seeing the price move back to the upside. We did break below this trend line right here. This was an ECB meeting and an employment day. I reestablished that line right there. It came down toward the 38.2 at the 102.04 level and rotated back to the upside. The 38.2% retracement on the downside is probably a technical level that you want to pay attention to. We went below it on two separate occasions to the downside. A move below that level on the downside tomorrow should not be ignored. Look for a move down toward the midpoint of this move and also the 100-day moving average. We haven't been below the 100-day moving average since this period going back to November. A move below the 38.2 and staying below that level in tomorrow's trading heads on down to that level. On the top side, and by the way, the 200-day moving average, also a level of really a huge importance, not just tomorrow, but going forward as well. The market went below the 200-day moving average on one day here. We had, maybe a few attempts below that 200-day moving average on a few, maybe 3 or 4 days where the market actually traded below it. No closes below that level, going all the way back to 2012, October of 2012. So in 2014, if we move below the 200-day moving average and close below that level, mark that on your calendar as an important technical level, and understand where that level exists. So these two moving averages, important, mainly because we haven't been below them. We haven't been below the 200-day moving average. We haven't spent a lot of time below the 100-day moving average as well. So key levels, that's all going to start on and break below the 102.04 level. On the top side here for the dollar versus yen, the other levels on the top side include getting through the lows here from for the month when we went below it, and we're kind of hanging around it right now. And really have to go through to the hourly chart and understand here in the recent history on this move to the downside, which we've seen over the last 2 days. The 100-hour moving average, the 200-hour moving average kind of got the ball rolling on the downside. So taking back those levels on the top side is what's going to push this market to the upside. All right, I'm going to end it here. I see a lot of frustrations going on here, and I apologize for. There's always one in the crowd, and the one he's making his effort to harass me wherever I go, and that's his prerogative, I guess, in a free and open world. But I'll have to deal with that maybe at some other point along the way. Apologize for his behavior as usual. There's nothing I can do as far as technical issues. Everyone goes. I hope you got some benefit out of today's webinar, and I want to thank the people at FXDD and apologize for any issues or frustrations that you may have had in today's program. All right, thanks a lot. Good luck to tomorrow. I'm going to be on my normal site at livestream.com. through the reports tomorrow. I'll do another look at the market at that time. Snapshot, of course, there's time between now and then that could cause the market to move one way or the other. I do expect the Fed to taper like $10 billion, but like last month, I don't necessarily know what the reaction might be or what might be through that taper. I do suspect that the dollar might get a little bit stronger, but that's just my suspect. What I suspect, I wish you all good luck, and we'll talk to you again next month. Thanks a lot, people at FX Street. Bye bye now.